Good morning, everybody, and welcome to Capital International's Going for Broke webinar. I'm David Noon, Commercial Director for Capital International in South Africa, and I will be your host today. Firstly, I want to thank you all for attending. Although the content is mainly focused on South Africa, it's great to see we have folks dialing in from the UK, the Middle East, and also from the Isle of Man, where our head office is based. I want to start off this morning with going through some housekeeping. The webinar will be for a panelist discussion lasting approximately 1 hour, and we've got 4 great panelists today for you. This will be followed by an open Q&A session, and all questions can be submitted in writing through the Hopin system, and feel free to ask any questions at any time, but they'll all be answered at the end of the panel discussion in the Q&A session. To post your question, on the right-hand side of the Hopin screen, you've got Stage, and you click on Chat to write your question. Also, remember to add who your question is directed to. We'll also be asking a few poll questions during the webinar. Again, on the right-hand side, Stage and Poll, you can answer the poll questions throughout the webinar. So that's a bit of the housekeeping taken care of. Now let's give a brief introduction to our panel members. Our first member is Graham Fisher. Graham's an independent investment manager with 48 years of industry experience. And Graham will be discussing South African investment markets, rand depreciation, and the latest SONA outtakes. Following on from Graham, we've got Ray Becker, our new Executive General Manager for Capital International in South Africa. And Rake has recently returned to South Africa after 20 years working in Europe and the Middle East. Rake will be looking at past SONA retrospectively to ascertain over the last 20 years if the SA government is all talk and no delivery. Following on from Rake, we have Ulrich Strandvik, an attorney and tax specialist from Gunston Strandvik Attorneys. And Ulrich will be covering the tax implications of the recent budget announcement and why the South African government will need to tread very carefully. Finally, we have our very own James Fitzpatrick, an investment manager for Capital International from our Isle of Man office. James will be updating us on overseas investment market and his new perspective from a South African investment manager based in the Isle of Man, as James recently relocated with Capital International. So that's an introduction to our panel members today. I want to just look back over the last couple of weeks, because they've been extremely eventful in South Africa. We've had Ramaphosa's State of the Nation address, where he set out his priorities and objectives, and I know Graham is going to talk about that in more detail. We then had that followed by the budget announcement, where most of us were expecting significant tax increases, and I was especially. We then had the good news this weekend of the release of the lockdown, so we're now in level 1 in South Africa, but we're also conscious of the impact of COVID on the public purse and the economy, and obviously the significant job losses in South Africa. So ask yourself, what is the potential impact for South African investors, and what should they now be considering? So I hope that's got the brain stimulated a little bit. What I'm next going to do is move on to the panel, and our first panel member is Graham Fisher, who is going to talk about SONA, South African investment market, and rand depreciation.
Good morning, everyone. It's a privilege to be on such a highly qualified panel. As you've heard, my only real qualification is 48 years experience in finance and investments. This morning is age before beauty, so I'm going to jump straight in. Before I do that, if you look on the right-hand side of your screen, you'll see that the first question is already up there. Where do you see the rand-dollar exchange rate in 12 months' time? And we're looking for your view on that. Before you answer that question, I'll just suggest that maybe you wait till the end of my presentation. I've got a nice chart on the rand, and I'm going to be talking about factors that affect the rand in the short term. I'm going to kick off by talking on SONA And you'll see now there are just a few pointers on the SONA address. There are a number of positives. The extra 1 million chickens per week due to government initiatives is a positive. Boost to local sugar production, which will reduce imports. That's another positive that comes out of SONA. And for me, the big important one is the rolling back of government monopoly on energy. I think this is very good. It's unfortunately been a long time coming, but it's got a number of important results. And as people produce their own power and go into the net, it's going to reduce pressure on Eskom. There are, of course, also a number of negatives. I've been accused of being a pessimist, but I'm an optimist by nature. But when I look at the facts and figures, you've got to weigh up the pros and the cons. The negatives, of course, are not stated in the SONA, and you've got to read between the lines. An example of that is they are talking about conceptualizing smart cities, which is a very good concept, and hopefully this will work out. But we are 27 years into the new government, and you wonder why they haven't come up with this before. Also, they talk about progress on several major water infrastructure projects. Now, if you read behind the lines, that should really read that sewage is now running in the streets, and we now have to fix what we have not been maintained for the past 25 years. And there are many examples of that. The SONA also talks about massive infrastructure projects, and we'll come back to that. And they need to prepare these and manage them. They're talking about this as if this is something new, but one must bear in mind that the largest infrastructure project that we've had is Eskom. And how has this been managed over the past 25 years? And now they want to accelerate BEE. So that doesn't encourage me very much. Let me leave that and get back to the budget. In the budget, we've got a couple of positives as well. Bracket creep, where they've increased the brackets by about 5.15%. This is positive and obviously reduce the tax that people pay. Against CPI, which is maybe about 3.2%. So it's a real improvement of about 2% for individuals. And then company tax rate is going to come down only next year in 2022, but that's also positive. One asks the question, though, the expectations for the budget at this time was that taxes would be increased. And one's got to say, well, why didn't Tito Mboweni leave things as they were and use all the extra revenue to pay for COVID and the extra expenses? Also, the budget shouldn't be viewed as a one-year event. It's really a 5-year plan. And as I said, there's massive spending taking place. Now, if you look at the chart that is up on the screen, you'll see for many years, expenditure has actually exceeded income. Now, that can't go on indefinitely. If spending is exceeding revenue, what is happening? And if you look at the next slide, obviously that spending is coming out of borrowed money, out of debt. And government debt has been increasing substantially over recent years, and the golden bar is over. The current one is just under $4 billion. Now that 4 trillion rand, and this is huge for me. This is the elephant in the room. The Tito Mboweni talked about how many zeros does a trillion have, and a trillion has 12 zeros. This is huge, And I'm seriously worried about this and what's going to happen in the future. You'll see the next chart emphasizes the gap. Anything below the line, and everything has been below the line since 2008, all of that is adding to debt and to the big elephant. Tito Mboweni clearly stated that increasing government debt results in higher taxes and also means that spending will be redirected from important areas to service the debt. So one's then got to ask the question, why is he going down the high-risk road of increasing government debt further in coming years? And this is the risk. And I think this is why our talk today has been entitled Going for Broke. The accepted understanding of the term going for broke is going all out or risking everything in an all-out effort of a better result. And Tito is actually following the Keynesian model. He's lowering taxes and increasing government spending to revive the economy after a significant shock. And this is valid. He's not doing a lot on lowering taxes, but he's certainly planning to do massive spending. Again, there are a couple of positives on this. So the rolling back of the government monopoly on energy is a huge factor. And this could actually lead to substantial reduction in load shedding or almost a complete elimination of load shedding in coming years. And that's very positive. For me, that's the positive elephant, if you want to call it that. Another huge positive at the moment is the economy is in a strong recovery phase with commodity prices rebounding from about April 2020. South Africa is has substantial natural resources and is primarily a commodity producing and exporting country. And the top 5 exports by value in order are platinum, motor vehicle and parts, iron ore, coal and gold. So increasing exports is going to help the economy in the short term. The above factors do reduce the risk of Tito's strategy, but with COVID and the changes that we've had, there's much uncertainty remaining, and who knows when the next black swan is going to fly overhead. What will happen when we can't start reducing borrowings in a few years' time? If we can't reduce borrowings, what are the alternatives? And there are at least 3 alternatives that I've come up with. We could go to the IMF or the World Bank for a loan. Now, of course, we have just very recently taken a loan of 4.3 billion from the IMF. And because that's a special COVID loan, there are very few conditions attached. But any future loans from IMF will certainly come with conditions, and that will restrict South Africa and probably lead to a lot of austerity budgets. We could borrow more from China, but I think borrowing from China, the risk is that you might be selling the family jewels to repay that loan in future years. The third alternative would be to privatize or sell some state assets. And this is a real alternative, but it's debatable as to how much value is left in state-owned enterprises after several years of mismanagement. So will the strategy succeed of growing the economy by increasing spending? And of course, the jury's out on that one. Let me turn now to a few comments about the state of the economy. Right now, GDP is expected to decline by 7.3% for 2020. That's a huge knock. I think that's probably the worst knock we've seen in my lifetime. GDP is expected to expand next year by about 3.3%. Unemployment rate is sitting at 32.5%. Interest rates are down to over a 40-year low. The repo rate's at 3.5%, and rates were decreased by 2.75% in 2020. So lower interest rates are good for the economy and should see some revival there. CPI about 3.1%. The Chamber of Commerce has got a business confidence index, which they started in 1985. That's sitting at 86.5, which is the lowest level since they started that index. And it touched a low of 70.1 in May last year. The Rand, which is a very interesting one, and let me bring up my next slide. This is the Rand going back 10 years. And the long-term trend in the Rand is actually down. The Rand is quoted the wrong way around, so a rising trend here is actually a weakening of the Rand. But the Rand is strengthened. You'll see from the middle of about April 2020, the Rand has gone from 19 to about 14.5. At the moment, sitting at about 15. And one has to say, well, why has the Rand strengthened in this period when politics is bad, we've got COVID, and things don't really look good for the country? And I think there are two main reasons. The most important reason is that the commodity boom that I've just mentioned earlier. With commodities rising, this is making the Rand strong because our exports are increasing. It's very positive for growth. As I mentioned earlier, the 5 biggest exports are all commodities, or four out of 5 of them are for commodities. You'll see too that in the period from January 2016 through to February 2018, the Rand also strengthened from about 17 down to about 11.5. That was a tremendous period of strength, and that also corresponds with a strong upward move in the commodity cycle. So that's really the main reason why the Rand is firming. The second reason is that emerging markets are already back in favor, and the large markets, the global markets have gone up, and people are risk on are now looking at emerging markets. So that's the two reasons why the Rand is firm right now, and should expect it to be. We expect it to remain firm, provided the commodity cycle is positive, and provided emerging markets are in vogue. Right, just to summarize, I've attempted to summarize some positives and negatives from SONA, the budget and the economy. And I would like to be optimistic about the government 5-year plan, but my enthusiasm is depreciated by the government's poor track record of delivery versus promises. Rake has done a study on this, and he'll be joining us shortly. Just one last reminder to please look at your Rand prediction now, and if you could let us know what you think the Rand's going to be doing in 12 months' time. Right, over you to Rake.
Well, thank you, Graham. Thanks for that, and David for the introduction, and also to Ulrich and James for joining us as panelists, and a very warm welcome to all the attendees to Capital International's Going for Broke. I hope you're all well. Well, the team asked me to reflect on my experiences and views returning to South Africa after 20 years with SONA as the backdrop. I left South Africa for Amsterdam on the 16th of September 2001, and as you will recall, that was the year the Twin Towers was attacked. So this was 5 days after that terrible attack, and I remember it was a very strange time to fly. A lot of nervous people on those flights, which is very understandable. The airline industry took a downturn in the aftermath, and it changed the way we travel and how we all love the security checks. It's certainly a bit more relaxed in South Africa than some of the European airports I've been through. Move us on for 20 years, once again, what hopefully is a lifetime event. An international pandemic has brought the airline industry to its knees, and it's changed the way we will travel in future. Vaccine passports might be the way to go, and I'm certainly one for it. So what does this have to do with SONA? Well, all governments might have had the best laid plans, but this can be kicked into the long grass very quickly by events completely outside their control, which in turn then becomes all about damage control and how good you are in managing this with your available resource and reserves. Unfortunately for South Africa, it feels a little bit like they were not even on the starting line, but still putting on their kit in their dressing room, truly on the back foot. Having spent 20 years outside of South Africa, I've always stayed close to South African affairs, the ongoings here, due to my family connections, my love for the country. I'll always be a Free State boy. That's where I grew up. I've followed and watched with interest over the Mbeki years and now the Ramaphosa years. So what I've done is over the last few days, I've been reading through 20 years of sonar addresses, which sounds very painful, but as a matter of fact, was actually really interesting to read, because the reason being that it gave me some really good insights into the longer term thinking and strategies of the various governments, and also made me aware of so many initiatives that I just didn't hear about living abroad. My original intention was to then focus on the top 10 main initiatives or themes in each year, and then rate them green, amber, or red in terms of delivery. Well, what I very quickly realized is that it's almost an impossibility. When you read these in detail, over the 20 years, there's been literally hundreds of initiatives, which would not be possible to rate on their success. I'm sure many has been successful, but there would be a very good amount that never really worked. It also then made me think that maybe herein lies the problem of some of the challenges we see today in South Africa. Graham sort of alluded to it earlier, overpromise and underdeliver. It seems to me it's a running theme through the last 20 years in South Africa. I fully understand that any government that wants to progress the country will try and do as much possible, but with the best will in the world, if you don't have the resources, expertise and funding, and on top of that, some of the money actually never ends up where it was intended to, you're truly set up for failure. The golden rule of project management springs to mind. Manage expectations by underpromise but overdeliver. By trade, I'm an accountant, and rather than trying to super analyze each initiative from the sonar speeches and to get a better understanding of whether things have changed for the better or worse, I thought it's better to revert to my comfort zone. Bring out the old Excel spreadsheet and look at some of the key indicators on the spreadsheet. So let me just share my screen with you and bring it up. Bring it up. So sorry if it's a bit small, but what I try to do is fill in some of the key indicators and also who was the leading president at the time. So from the Mbeki years all the way to Ramaphosa. So if we start at the top there, this S&P rating, I use that one. So we actually, in the early 2000s, as we all know, we started off with BBB minus, and actually things improved. Throughout the 2000s, we ended up on BBB plus, and that remained for at least 8 years. And then things started going wrong, and it started in the late sort of 2011, 2012, and we've just been seeing it sliding, which is unfortunate because, of course, that impact investor relations in South Africa. So that's the first one. Unemployment rate. Now, unemployment rate remains a massive issue for South Africa. But even if you look back in the history of South Africa, it's always hovered around 30%. Yes, true, it's come down. If you can believe the numbers, it has come down on certain parts. But it's an issue that it's never been able to resolve, and is actually a big burden for the country. GDP growth rate, as we can see, over the years, that's declined. When you look at some of the sonar speeches and some of the predictions they make, the numbers are so far apart that you can't quite believe it. Foreign trade balance has played a bit of ping pong. So some years it's sort of positive, and then it moved down and up again. Consumer inflation again, that's moved down. And then the one that we all watch, and I know in our business we watch the currencies really well. Because we know when there's big movements, then everybody gets nervous and money starts flowing. So, as Graham also said, if you look at the dollar versus the rand, it's gone from 7.74, and that's sort of the end of the year, and now we're standing, sort of around 15, just over 15. The other big issue we've got in South Africa, as we all know, the South African crime rates has been a big issue that's been a massive struggle for this country. But that's all linked to unemployment and that sort of stuff. And it's true to say it did come down for a long period, but it's a scary thought that it's on the rise again. So that's not great. And then, of course, one of the other big issues we've got in South Africa is actually how many taxpayers we've got, how many people contribute to the tax burden. And in South Africa, when you look at the numbers, it's actually lately, I think if you look at the population, which it's almost 60 million, it's less than 12% are contributing to tax. It's just unworkable. If you compare that to the UK, I know it's a first world country, but you've got just below 50% of the country contributing in some shape or form. So if you then look at all these numbers, it's not a great story. It just doesn't look good for us. So however, let me just stop sharing my screen review and come back to myself. So, however, I'm an internal optimist, and I cannot just believe in doom and gloom. In my view, and that's my view alone, I think South Africa isn't done yet. And there's still some time to move us back in the right direction. But the drive needs to be there, and they will have to step up on the accelerator a bit. What is very noticeable from my various business travels around South Africa since I've returned last year is the demographics have changed. We have a very young population that is extremely resilient. They are hungry for success and they want to be successful. We have endless entrepreneurs in this country. We have plenty of opportunity, and from the money flows we see for our own business, we know the money is out there. The question then is, how do you channel that energy and drive? How do you channel that energy and drive and money to the right places so we can create more jobs, grow the middle classes, improve investor confidence, and generally turn South Africa in the right direction? To move South Africa back on that track, in my view, here is just some fundamentals that I need to change, and time isn't our friend. If this doesn't change, I think South Africa will continue down this rocky path for many years, and things might not get better. So, number one, one-party politics don't work. For a true democracy, you need competition to keep you on the straight and narrow and keep you honest. In fairness, South Africa's never really had a democracy. But all I'm saying is history shows that having one ruling party doesn't work. The ANC needs some true competition with the real chance of another party becoming the ruling party. Unemployment, as I said earlier, unemployment hovering at 30%, you can't continue like this. Something needs to be done about it. It doesn't help. That drives some of our crime rates and our corruption. Again, if you compare it to the UK, at the moment, the UK's unemployment rate, which is actually at an all-time high, is sitting around 5%. So you can see the challenge we face in this country. Corruption, we all know it. Corruption, it kills all your best laid plans. It has to stop. It kills investor confidence. It's time to truly hold people accountable. Number 4, stop wasting taxpayers' money on projects that's already dead in the water. Looking at all the hundreds of initiatives, I've no doubt that some have been very successful, but there will be a large proportion that has never happened or failed, and the money is still being allocated. And then on my last point about tax, a broader tax base with less than 12% of the population paying tax, it's something that needs to change. So the last point, before I hand over to Ulrich, that will talk more about the budgets and the impact of that and on tax, and another poll question that we can have is, I think that living around the world in various countries has made me realize that each country has its own unique challenges and problems. Some of these are deep-rooted problems, like we have in South Africa, which is complex and only solvable if, as a nation, we solve them together. We need the public and the private industry all to pull in the same direction. So if I can turn you to the latest poll question, if you look at the stage and you go to polls, so the latest question is, what should National Treasury do to increase the tax base and thereby increase revenues? And then you've got the 4 choices there. So if you don't mind answering that, and then I'll hand over to Ulrich that will talk to us about tax. Thank you very much.
Thank you, Rick, for that enlightening study, and thank you, David, for that introduction. It's a great pleasure to be here this morning in the presence of my esteemed colleagues and guests. This morning, I'm going to be focusing on the tax implications of the budget. There's a lot to talk about, so I'm not going to go into much detail, and I think the value is in the question and answer time. But I want to start my presentation with a quote from our Minister of Finance and what he said at the beginning of his budget speech. And this is what he said. He said, "We will not rest until we have fundamentally altered the structure of this economy by lowering barriers to entry, raising productivity, and lowering the cost of doing business." So in my mind, in terms of going for broke, it's clear where the government stands, and that is to stimulate and boost the economy. And as Graham said and Rick alluded to, talk is cheap, and it's in the doing that we need to focus on. And the question is whether the budget, in terms of tax point of view, is going to help us achieve the boost we need as an economy. So let me go to my next slide and look at what the economists and tax advisors saw in their crystal balls and what actually happened on the 24th of February 2021. Some economists and tax advisors said that the VAT increase would be unlikely, and that came true. There is no VAT increase, and there's none on the cards at the moment. The next big topic was the doomsayers saying that there was a wealth tax coming, which they also said was unlikely. And once again, that came true, but there was a warning that they are still assessing the Davis Committee recommendations on a wealth tax. That's not gone completely, and we need to keep our finger on the pulse there. The next projection was that there would be no adjustment to the marginal rate to provide for fiscal drag, and that didn't come true. Peter Mboweni gave an above-inflation adjustment to marginal rates, which in my mind is an attempt to placate the taxpayers and make them feel more positive towards paying taxes and getting something in their pockets. So if you look at real terms, if you earn R1 million a year, you are going to earn about 4,800 Rand more per year, which is about 400 Rand more per month. Then the next talk was hopefully that there would be an extension to Section 12J venture capital company investments, and there was, to great shock, there was no extension. It will be ending this year. The reason for that was the government said that it was only benefiting the wealthy in terms of tax rebates and not actually achieving its purpose, which was to stimulate entrepreneurship and small business. Then just on the general fuel levy, that came true. There is an inflation increase to those two fuel levies, and also obviously an increase in sin taxes based mainly on what happened during COVID, and that's excise duty has increased by 8%. So that is quite a big increase and quite a hit for the alcohol industry. And then some other highlights and other proposals made by SARS going forward is that they've allocated 3 billion Rand to SARS for improving technology and infrastructure and systems. Like, look at that picture in the screen. That is a queue to go into SARS in Long Street in Cape Town. That queue goes on to around the other side. And the key here is that, as it was alluded to by Tito, we need to reduce barrier to entry. And by giving 3 billion Rand to SARS, not that much, but it's something to improve the systems, to get people to register for tax, to make compliance easier. We need systems to be put in place that make it streamlined and easier for people to register for tax and pay tax and comply. Right now, it's a bit too complicated and it needs to be adjusted. If you look at some of the other proposals, there are strengthening of anti-avoidance provisions and monitoring of anti-avoidance provisions in the corporate restructuring, trusts, etc. They're looking at making sure that people pay the tax where tax is due and clamping down against anti-avoidance provisions. And also in light of COVID changed the way we do business, changed the way we do office, and they are now reviewing the tax for travel and working from home. Because it affects salary structuring, it's going to be a multi-year project, so it won't be immediate. And also in light of what Graham said in respect of the rollback of government monopoly on energy, we're looking at environmental taxes, changes to the eligibility for renewable any energy premium deduction, and changes to the formula to calculate the premium deduction. So before I go into the hot topic of exchange control, I just want to turn to the poll question on your screen, and just talking about Tito's what we call the income tax friendly budget. Whether do you agree that Tito's income tax friendly budget, the 5% inflation margin rate adjustment, no wealth tax, etc., may encourage tax compliance and/or stimulate the economy? And the answer is yes, I'm hopeful, and no, Ulrich, you're being way too optimistic. So if you could please answer that question before I move into the next point, and that is on exchange control. So please have a think about that. The next slide is on exchange control. And a big thing that happened end of 2020, beginning of this year as well, is the change to loop structures. That's a big positive. And in the past, a South African exchange control resident couldn't invest in a foreign entity that then invested back into an RSA asset. And that has now been done away with, which hopefully will boost investment into the country and also offshore investment. One thing that isn't there to note is that trusts haven't been indicated. So a trust cannot currently do a loop structure, and that is still yet to be seen. So it's going to be interesting to see how that pans out. And then just hot off the press, some new rules for financial immigration. Now, in the past, I'm sure many of you financial advisors have been talking about financial immigration and tax immigration, and there's been quite a bit of confusion regarding tax immigration and financial immigration, and there's been a move to bring that under the control of SARS completely. So the new rules, hot off the press, came through yesterday to the authorized dealers, and it hasn't been put out for comment, but this is apparently the new rules. So the whole application for tax for financial immigration is going to fall away. So you no longer need an authorized dealer to attest an application, no longer SARB approval, and no longer those archaic restrictions on bank accounts. That's all going to fall away, and there's going to be a new financial immigration process under the control of SARS, and they're going to look at tax residency and not residency in terms of exchange control. Do away with that confusion. So tax residency will be based on the Income Tax Act and not the exchange control regulations. And to financially immigrate, you will need an immigration tax clearance certificate from SARS. And SARS is looking to monitor exit tax. And when a South African leaves South Africa, there will be an exit tax on worldwide assets. And then also a stringent audit by SARS, and then also approval by SARS for expatriating the funds before you can expatriate any funds. So this is quite a big change to the financial immigration process, and may also impact upon how you invest offshore. And this leads me to my closing remarks, and just to say that it's clear that SARS, also that the National Treasury is looking to boost the economy, and let's see, because the proof is in the pudding. And exchange control regulations are being relaxed, and financial immigration rules are being brought under SARS for greater controls, and that does impact on our investments offshore. And there's no better person to discuss that right now than my colleague James Fitzpatrick. And over to you, James, and thank you for your time. I look forward to the question and answer time.
Yes, thank you, Ulrich, and thank you to everyone for joining our webinar today. Ulrich, I noticed your picture of your long queues, and I think you might have outside the SARS building, and I think you might have got that slightly wrong. To me, it just looks like a typical lunch break at SARS. So I'm not sure. You probably want to get that checked out. But I'm coming to you live from the Isle of Man, which, as most of you know, is a small island between UK and Ireland. So not Ireland, but between Ireland and the UK. And it's home to the world famous TT motorcycle race. So I've spent the last 18 years managing investments for high net worth individuals and pension funds. And 17 of those years was actually in Cape Town, South Africa. And so I only recently joined the capital, the team in the Isle of Man. And prior to joining, this was the beginning of last year, I spent a couple of weeks on the island just setting things up for the families to come across, looking at houses and schools, etc. And on my way back to South Africa, I actually missed my connecting flight. And they had to route me via Johannesburg. And I'll never forget, but they seated me next to this lady who looked dreadfully ill. She was coughing and sniffling the whole way through the flight. Now this was pre-COVID, so there were no masks, etc. And I just had to sort of grin and bear it. Anyway, a couple of days later, after I was back, I'm sure you've guessed it by now, but I came down with the flu. It only took 2 days until I had full-blown pneumonia. So I'm pretty sure I've had COVID. I actually tried to get a COVID test, but it was just, the world was only waking up to COVID, and you actually couldn't even get a test. Anyway, I wasn't aware of this at the time, but apparently I've become quite famous. I was all over Facebook, and school moms to book clubs were talking about me. And I was this father who'd come back from business trip to the UK, and I had all the dreaded symptoms of COVID. One mom actually said to me they were calling me Cape Town's patient zero. So speaking of zeros, and now that I'm on the other side of the pond here in the Isle of Man, I have to tell you there is zero sunshine. There's also zero interest on your cash. The flip side, however, is that the investment universe, is just immense and diverse, and you can access, investments in hard currencies and stable currencies, which is really a plus. And I'm just going to share my slides with you and take you to the first slide. Just looking at what as an investor investing in South Africa, what the top 40 shares has done over 10 years. You've returned about 95% on your capital, which is excluding dividends. This is an average compound return of about 7% a year. And on the face of it, it really doesn't look that bad. It appears like a decent annual return. But if we dig a little bit deeper and we look at the same top 40 shares over the same 10-year period, but instead of pricing them in rands, we actually price them in dollars, we get a very different picture. And we're actually seeing a return on capital in US dollars of about negative 13%, which is a return of about negative 1.4%. And as my colleague Graham, or one of our panelists, Graham, referred to earlier, the rand was the biggest contributor to the weak currency, which fell approximately 55% over that period. Now, as an example, if we just have a look at what one could have done in the S&P 500 over the same period, you would have returned about 195% excluding dividends, which is quite staggeringly different at 11.4% average compound return, as opposed to the negative 1.4 had we been sitting on the top 40 in rands. Now, I was always told that rand hedges were sufficient to protect you against the weaker rand. Well, that's clearly not right. Just having a look at what was last year about, we had the V recovery. You can see what happened, the big sharp drops sort of 219, 220. We're all well aware that we had last year was about the V. And really, it was really down to the quick reaction by central banks, and which resulted in the V. And last year was really about liquidity and actually not growth. That central bank printing was actually, if you look at it, almost as much as the previous decade. So in 10 years, what they printed, they actually printed just over COVID. The Fed there printed $3 trillion, just absolutely massive. And as you know, we've just seen the 1.9 get approved or partially approved in the US, and so we're expecting that to go through. So the more liquidity to be added to the system. Briefly, you know, looking ahead at what we can expect on the inflation side, you know, that's what everyone's concerned about. A lot of people are saying that inflation's just around the corner, and as we know, inflation is bad for investors, and we really need to be alive to how they can affect your investments. And the scare recently at the beginning of 2021, just in the last couple of weeks, is that we saw a jump in bond rates globally. And the question everyone's asking is this signaling an earlier tapering of government stimulus? Is this the end to the rise we're seeing in the markets, or is it just around the corner? So the sooner we see inflation, the more pressure that's going to put on central banks to raise rates, and the higher the rates, the more pressure that's going to put on equities. But this chart shows you that right now, in terms of where we're seeing inflation, that in the near term, we're not actually seeing too much pressure. What obviously stands out is what you can see in the euro area, but US, UK, and China going completely the other way. If you can believe those figures, CPI coming down. So we don't think in the near term there's too much to be concerned about around inflation. But given the amount of printing that's actually happened, it's definitely something you need to keep your eye on and be on your toes on that front. I think the next big question everyone's asking with what we've seen is, are the markets expensive? And to answer that question, I've just put up the US price to earnings ratio, which you can see over this period. And in fact, if you look over the longer term, it certainly appears to be very expensive. Looking at the FANGs, which are the big tech stocks in the US, they appear to be far less so. We think that the theme going forward is really going to be about being selective. It's important that you've got a manager who's going to be very selective. We don't think that the indexes are going to give you the same kind of performance that we have seen, and that it's really going to come down to selecting the right companies going forward, because not everyone's going to do so well. Before I hand back to David and the rest of the team, I briefly just wanted to have a look at what happened last time the US lowered rates to almost nothing. We actually had 7 years of strong market performance. Are the Fed going to hold rates down for as long as that this time around? Are we going to see markets respond in the same fashion? So a lot of food for thought, and a lot of things that we're actually looking at as an investment team, and just managing these events and circumstances as they come up. So over to you, David.
Thanks, James. Very interesting, guys, and I enjoyed that, especially Ulrich with the queue around the corner at SARS, because I was one of the people that had to stand in it. I hope that's given you all food for thought. Certainly has for me. What we're now going to do is open up for questions. So I'll just go over the process. So again, right hand side of your screen, if you click on the stage and followed by chat, and you can place a question in there and who you want to direct that to. Whilst you are putting your questions in there, I'll give you the results of the poll questions and also bring back the panelists to answer any of your questions. So the first question we were posed was, where do you see the Rand dollar rate in 12 months' time? Funnily enough, nobody and 60% believe it'll be 17 or above. Very interesting. The next one was, what should National Treasury do to increase the tax base and thereby increase revenue? Amazingly, nobody wants to reduce tax. And then we're split 3 ways between the other one: make it super easy to register and comply with tax. Well, we've seen by Ulrich's slide, that's not that easy. Create more tax incentives. And the final one is increase the ease of doing business in South Africa. And I've been watching this one closely. So do you agree that Tito's income tax friendly budget may encourage tax compliance and or stimulate the economy? Now, Ulrich, the first 6 people that voted thought you were way too optimistic. But then some people came to your camp and helped you out. So we've got a 40-60 split that 40%, yes, we are hopeful. Okay, so that's the result of the poll. We've got a question in for you, Ulrich. It's from Linda. I was told that the exit tax and financial immigration is no longer valid. You can just go and live wherever you want, and then they look at your tax residency.
Great, thanks, David. And thank you for the question, Linda. So yes, the exit levy is done away with. That's the South African Reserve Bank exit levy. However, the exit tax is a tax imposed by South African Revenue Service for when you no longer become a South African tax resident. It's called Section 9H exit tax. And when you leave South Africa, and there's a little tick box in your tax return that says that you become a non-resident in this tax year. And when you tick that, you are no longer a South African tax resident, and you are deemed to have disposed of all your capital assets, worldwide capital assets, at the market value as at that date. So that excludes immovable property. So just be very careful before you tick that box and before you go and live somewhere abroad and change your tax residency, to make sure that you don't have unintended tax consequences based on capital gains. So yes, so to clarify, the exit levy is gone, but the exit tax is still here. So SARS are going to monitor that quite closely. So when you leave, be very careful to make sure that you get the right tax advice before you tick that box. I hope that answers your question, Linda.
Okay, thanks for that, Ulrich. I think I'll go next. I've got a question for you, Graham. Listening to your presentation regarding reducing of South African debt between the IMF, China, or sell off the state-owned enterprises, which, being British, I saw that happen in the UK. Using your 48 years of experience, what do you think they should do?
Sorry, just say that again. I didn't catch that whole question.
So on your 3 points in relation, how can South Africa reduce debt with using a loan from the IMF or China, or sell off state-owned enterprises? Using your 48 years experience, what do you think they should do?
Okay, yes, thanks. That's look, that's very difficult because there's no absolute answer to that. You know, I'm hopeful that the increased spending will get the economy going, which will increase taxes, and we will be better off a few years down the road. We already have an IMF loan, as I mentioned, but further IMF loans will come with conditions, and they will be restrictive on us. They will say, you know, you've got to reduce spending, you've got to get back and live within your means. And that will be austerity budgets, and it will be painful for the economy, and we'll see limited growth for a long period of time. That's not a great option. The best option, I would think, is probably the sale of some of our assets. But then I've put the caveat in there that I'm not sure how much value there is. And an example of that is Denel. I mean, Denel was a producer of defense products. The Roy Falk helicopter was a very good product of theirs, but they actually never ended up selling anything. But mismanagement of Denel over the last few years has happened, and I'm not sure if there's any value left. You know, I don't know who would buy it. So there are not many options. This has got to work. And I think we've got to monitor this every year, budget to budget, and see how it's panning out. I was very optimistic, Ulrich, when Ramaphosa came into power, that we've got rid of Zuma. Ramaphosa, good chap, he's well educated, he knows the economics, and he knows what's important for offshore investments, and things are going to come right. But it looks as though he's been fighting to get enough power to actually make the right decisions, and he's been hamstrung for the last few years. I think a real signal that he's got the power is if Zuma was put in jail. That would put the Zumarites out of kilter, and would give him far more power. That would be very positive. But again, they're kicking the can down the road, and they're postponing it. So we wait for some positive developments. You might remember 2 years ago, they promised that 2020 was the year that all the corrupt people were going to come to court and end up in jail. Well, we're now a year down the road, and very little of that has happened. So we'd like to see that happen, and I think that would be positive. Hope that answers the question, David.
It did. Thanks, Graham. Okay, Ulrich, we've got I think you've stayed the pot with your tax presentation. We've got a question from Steve. If you own a property overseas and decide to emigrate, what will the tax be on the capital gains of your overseas property?
Great, thanks. Great question, Steve. And it would be a complicated one. Thank you. So as I understand it, Section 9H excludes immovable property. So it will only be on your share in portfolios, etc., etc. The good question there is, because it's overseas property, you need to look at the UK tax laws from going to be a non-resident to a resident in the UK. There might be a step-up principle there or the UK, but I'm pretty sure they follow our rules. But I'm not a fan with UK income tax. So just be careful on the other side, and remember there's always a double tax treaty between the UK and South Africa, and you won't be paying tax in both jurisdictions. So I think that's the answer. There's no tax on immovable property, and the key is to check the laws of the UK on the other side.
Okay, thanks, Ulrich.
Cool.
Question to you, James. You've left South Africa, although only to the Isle of Man. Do you think that scrapping exchange control regulation will boost investments in South Africa?
Thanks, David. Yeah, look, I think it's going to help. It's difficult to really understand how much help it's going to do. You know, they've relaxed exchange controls substantially already to this point. So I think the impact would be muted, but, you know, Tito's clearly trying to make things as open and less complicated as possible. And they're really trying to tap into the foreign direct investment as a way to assist funding the deficits that we see. So I think they're going to do, you know, whatever is possible to make it easy to invest in South Africa, and even if it's just to decomplicate, you know, things for a foreign investor, that's what it'll achieve. So yeah, it certainly might help. Yeah.
Okay.
Great. David, can I just come back to Steve's question? I just double check Section 9H, and I stand corrected. Actually, it only includes South African immovable property. So that's quite significant. So there would be a capital gain tax for foreign immovable property, and the key there is to make sure that there's not a double tax situation. So you would have to get the market value of that property as at the date you become a non-tax resident, and the difference will be a capital gain in your hands and taxed at our rates. And then if the same applies in the UK, then you'll have to do a Section 6 squat write-off. So yeah, I stand corrected. Sorry, Steve. But yeah, only includes South African immovable property. So, great.
Okay, thanks, Ulrich. Question for you, Rick, and it's come up quite a lot when I've met our clients and told them that you'd be coming in as new executive general manager. Why are you coming back to South Africa when everybody else is leaving? And what have you found since you've come back?
Good question, and actually a lot of people ask me that. I guess at heart you're always a South African, aren't you? You know, I'm a Free State boy that grew up in the middle of South Africa, and in the time when I left in 2000, I did it for work and I did it for all the right reasons because I've had opportunities, but I never kept my eye off South Africa, and I've always had that yearning to come back. Working for the right company, it's and for me, you need to hedge your bets a little bit. Even I have to say that. So it's great to work for an international company that's got a presence in South Africa. But we are contributing to this economy, and I think that's for me. I wanted to come back and also do my little bit, even if it's Capital's got a great future in South Africa. We're growing the business, and that's what it's all about. So it's all about opportunities. The time is right. I've had 20 years out of the country. I've in that time I've built up my foreign asset base, and it was a good time to come back. So it's not, South Africa's got its challenges, but it remains a great place, and I still see it as a place that we can turn the tide.
Okay, thanks, Rick. We've got a question from a colleague of ours to you, Ulrich. Do the budget changes make it any difference to buying a property easier or more difficult in South Africa? You're on mute.
You're mute.
Thanks, David. Thanks, Anthony, for that question. Actually, it's a good question. So the idea is that with the changes in the marginal rates, there's more room to buy property and more kind of leverage. But the bigger issue here for us is the exchange rates and interest rates that have come down in South Africa. We're in the property business, our firm as well, and we've seen a significant increase in property transactions between 1 million and 4 million, especially because of the interest rates coming down. And that's really stimulated the property industry. We are inundated with business in that range, between 1 million and 4 million. And it's because interest rates have come down mainly. But I think the budget is a positive step to carry on in that road, because it does free up cash to afford a bond. And those people that generally had a barrier to entry to get into the property market can now get into the property market, especially in the middle range that I just mentioned. So yes, it is a positive step to buying property in South Africa. And that's for South Africans, and obviously foreigners, it's different. You can only borrow 50% of what you bring in. But the interest rate being low, it could be a good option for you as a foreign investor.
Okay, thanks for that, Ulrich. Just to add to that, Ulrich, in Capital we normally have it's a £10 fine for being on mute, so it'll be 200 rand for you to the local charity. Okay,
great. Thank you.
We've got no more questions, but before I end the webinar, do any of you guys want to add anything from your presentations? I'll take that as the silence as a no. Okay, guys, I just want to thank you all today, everybody in attendance. Thanks for your time. I know we're all extremely busy at the moment. In the background, I want to thank Minna Perrott. She's had a very early morning from Isle of Man, and locally, Jackie Holiday, who kind of describes these webinars as herding feral cats trying to get us together, but she's done a great job about it. And just everybody out there, we are recording this. It will be available. So we send in an email, and if you want any further information on what the panel's discussed or anything about Capital International, please reach out to myself and my team. And finally, thank you all again, and have a great day. Enjoy, everybody.